Hi, I'm Dana Samuelson, president of American Gold Exchange, and this is part 2 of our special inflation report, Inflation's Disruptive Power, Inflation's Cost and Effect. In this video, we'll try and keep it to about 25 minutes. We go through how inflationary pressures unexpectedly are putting strains into the financial system. And I asked our vice president, Dr. Bill Musgrave, what he thought would be a good analogy for what's happening in the today with inflation in the financial system in a way we all could relate to it. And Bill said to me, it's like a patient that's on life support and their blood pressure goes up. And the only response you can make is to take the patient off of life support. So over the last 10 years or so, the federal funds rate here in the US and the ECB's rate in the Eurozone has been zero or negative. That's what we mean by life support. Okay, economies of the world, if they're doing well, they don't need interest rates to be zero. We love it because it makes things cheaper for us to buy, like houses and finance things, but it really means there's problems with the overall economic system. And now inflation has pressured things up, blood pressure. And what are the powers that be doing? They're taking the economies off of life support. And this could be a disastrous recipe in the future, depending on how things go. That's why we think it's important to share this information with you today. So let me share my screen. Where are we? There we go. So this is American Gold Exchange. This is how you reach us. Part 2, inflation's cost and effect. So taming inflation could be exorbitant. The Fed has encountered little pushback to its tightening campaign, but they will likely soon change as the fiscal impact of higher rates becomes clearer. This is a Bloomberg story from 2 or 3 weeks ago. This chart shows where our debt to GDP ratio was back in 1980, at 31%, actually in 1979 and 79, when Paul Volcker raised the federal funds rate to about 16%. So our debt to GDP ratio back then was 31%. Today, it's 125%. So we're 4 times more indebted today as a nation than we were back in 1980. This is why it matters. This is from the same story. When Paul Volcker raised rates aggressively in the last inflationary cycle, total debt to GDP was about 31%, as the chart showed. And the cost of servicing that debt was initially 9%. Even though he raised the rate of debt service to 16.5%, close to double, the resulting total debt payment was only 2.3% of GDP. So in other words, the interest payment on the debt was only 2.3% of GDP at one of the peaks in the Fed funds rate. Since the end of 2021, the debt service rate has risen from about 1.35% life support to 3.14% now. So it's more than doubled. However, with a total US debt to GDP ratio of 125% today, the percentage of debt service to GDP is already 2.23% of GDP, where it was at the peak of the last cycle. If the Fed is forced to raise the debt service to 6 or 7% to tame inflation, the resulting debt service would total about 6.5% of GDP, or 1.5 trillion, which is equivalent to or more than the amount of money we spend on defense spending every year. Recently, our interest on the debt has been about 500 billion, and that's because the rate was so low at about 1.35%. Very quickly, we showed this in the last video. Here's our debt, and it's exploded in the last 26 years, 6 times. And that's where the trap lies for higher rates versus our debt. That's just one of the problems. Here's a chart that shows the 10 largest economies in the world today. US is the largest. Japan is the 3rd largest. Italy is the 8th largest. But look at the debt to GDP ratio. Now, these numbers are a little different than what we just showed, but they're close. Japan's debt to GDP ratio is 256% today. Italy's debt to GDP ratio is 155% today. The US debt to GDP ratio is about 134%, 125%. We're still 3rd on the list, behind Japan #1 and Italy #2. And what's been happening to our treasury yields? Well, they've been rising. That's the blood pressure, rising because of inflation. Investors are demanding higher returns for their risk because of inflation. The 10-year treasury's gone from about 60 or 70 basis points all the way to over 3.2% recently. It's coming off a little bit right now. The British 10-year got to almost 2.5%. It did get to 2.5%. It's about 2% now. The 10-year German rate got to 1.6%. It's about 1% today. And all the way on the bottom is Japan, who's held their rate at 0.25%. Now, this is the most indebted economy in the world. And that little spike that's indicated and drawn out by the red oval shows Japanese investors dumping Japanese bonds in June of this year. The Japanese Treasury has been printing money to buy Japanese bonds. The Japanese government holds over 50% of the outstanding Japanese bonds. Private investors hold the rest. And that is when private investors capitulated and dumped Japanese bonds at the highest level they have in years, because the return they were getting was not near enough compared to the risk that inflation's pressures are creating, and especially relative to the rates they could get elsewhere. That's important to understand. Foreign investors in Japan dumped Japanese treasuries to go take their money elsewhere where they'd get a greater return. And the Japanese government almost lost control of the peg they're trying to hold at 0.25% on their yield. This chart shows how big that dumping of Japanese bonds has been by foreigners relative to what's been happening over the last 5, 6, 7 years. It's been double. So foreign investors have fled Japanese treasuries in the last month or two. They caused the yield to spike, which forced the Japanese government to print more money to buy more bonds to push the yield back down. That's how it works. But what has given, and materially, is the Japanese yen. It's cratered relative to the dollar in the last 3-4 months, down 29% this year. That's the release valve for that equation. Foreign investors have shed the bonds, shed the currency to go elsewhere. And it's caused the Japanese currency to drop to its lowest level relative to the dollar in 20 years. Now, we've seen a similar problem in Italy, where the Italian debt yield spiked as well in June. You can see it on that spike from 2% to 2.4%. This is the spread between Italian and German 10-year yields. So Germany is the economic engine of the Eurozone. And Italy's a big economy, but they underperform relative to Germany. This is the spread between the German yield and the Italian yield, which was unacceptable to the ECB due to their parameters for each country's financial requirements for yields and debt. So what did the ECB have to do? Because they're on the same currency. Now, prior to the euro, this would make the Italian lira drop relative to the German mark, but they can't do that now because they're on the same currency. So what does the ECB have to do? They have to create a special mechanism to push the Italian yields back down by buying their bonds. And how do they do that? They use proceeds from German bonds to do that. So this is a story out of Reuters. The ECB bond aid plans fault lines exposed by Italy's political crisis. Now, Mario Draghi, the Italian, sure he's president or premier, he's been forced to resign, creating a governmental crisis in Italy. So a government crisis in Italy is complicating a politically sensitive plan devised by the ECB to support indebted Eurozone countries on the bond markets before it even starts in earnest. In an unprecedented effort to cap borrowing costs, the ECB said last month it would buy more of a given state's bond if its debt yields rose too far in an unwarranted fashion. The scheme, using the proceeds of the ECB's existing bond holdings, as well as a new mechanism to be unveiled next week, well, it was unveiled the other day, called TIPI, was a response to a sudden rise in yields across Southern Europe. So this is part of the inflationary pressures. Their investors weren't getting enough return for the risk that the Italian bonds presented, so they dumped the bonds and spiked the yield over acceptable limits in the ECB, creating that spike between the German and the Italian yield. And now the ECB has to step in with a special mechanism to keep the blood pressure down. And again, this is the differential between US yields, British yields, German yields, and Japanese yields. And what is that doing? Well, that's benefiting the dollar. And the dollar's been on a tear. On July 5th, we put out our last video titled Strong Dollar Puts Gold on Sale, where we go through some of this. But you can see how strong the dollar has been for the last 2 years. It moved higher since June of 2021 when the Fed first floated the taper idea. And it surged dramatically in the last 4 or 5 months as we've gone into our rate hike cycle. And it's caused the yen to crater against it, as we talked about. And it also caused the euro to crater against the dollar, down 13% this year. So the dollar got back to parity with the euro for the first time in 20 years. We're seeing a little bit of a reversal right now on this because the ECB raised rates the other day 0.5 point for the first time in 11 years. And that's created an inversion where the euro caught a bit of a bid and the dollar sold off a little bit. But this shows how strong the dollar has been relative to other currencies. And this goes only to May of this year. And that's actually gotten more exacerbated in the last couple of months. So this is part of what inflation is doing. It's creating pressure within the financial system that is causing stress in bond markets, the biggest markets there are in the world, and causing currencies to change value dramatically against each other. And when the dollar is strong, that's great for us. We can go out around the world and buy things for more dollars than we could buy 6 months or a year ago. Right? But a prolonged strong dollar creates problems in smaller emerging markets who've bought or who've borrowed money in dollars, because now the service of their debt in dollars costs more. And this tends to break things if it stays that way for a long time. Not saying that's going to happen, but it could. And it's all because of inflation's pressures that we've seen rise dramatically in the last 2 years, especially in the last 6 months. Now, here's the Eurozone's inflation rate too. They're at about 8.5% today, where we're at 9.1%. And I said in the last video, the Eurozone is especially prone to energy shocks because they're dependent upon Russia, Germany in particular, for natural gas supplies, which Russia turned off due to a turbine getting repaired in Canada that's now being exported. But we'll see how that all translates. But there could be some real energy shocks in the Eurozone this winter because of no supplies from Russia for natural gas. And the oil price is a little tame right now. It's about $95 a barrel, where for the last 4 or 5 years, it's between 45 and 75 a barrel. In the last 3-4 months, it's been between 95 and 125 a barrel. If oil holds up in price or goes over 125 a barrel, it's going to create more inflationary pressure. So we have to watch the price of oil. That's an important thing that you can follow on a daily basis to see where the trend's going. But here's the ECB rate going back to 2000. As you can see, since 2009, actually since 2012, the ECB has had 0 or negative interest rates. And they've just now raised their rate a 0.5 point back to 0. That's a patient on life support. That's unusual. Now we've kind of grown used to these low rates, but it means the patient's on life support. And that at the top of the chart on the right is inflation at 8.5%. So in the Eurozone, they're 8.5% behind inflation with their interest rate. Okay. And in the US, we've got the same thing. The patient was on life support from 2009 to 2016. We could only get to 2.5% in 2018 before the Fed caved in the last time and put the patient back on life support when there was a global economic slowdown in the fall of 2018. Now, because of inflation's rise, the Fed's got the Fed funds rate back up to 2%. And it'll probably be 2.75% by the time you watch this video. I'm going to be on vacation when you see this. And that's next Wednesday's announcement is probably going to be 2.75%. They'll raise 75 basis points, but inflation's at 9.1%, which means the Fed's about 6% behind the curve right now. Now let's go back to the chart we used in part 1 to show you where the Fed funds rate was and inflation was before. Do you see any point in time when the Fed funds rate was 6% or more over the inflation rate in the first half of under the inflation rate, in the first half of that chart? No. The Fed and the ECB are so far behind the curve right now that they've got a lot of catch up to do. And there may not be the political will today to play catch up in this cycle like Paul Volcker had in the last cycle, because the economic pain could be greater and the pressure could be greater to ease into a weakening US and global economy to create more stimulus, to put the patient back on life support. So this is a really, really critical juncture that we're coming into to see how inflation continues to persist. And we expect it will. We expect it to mitigate some, but we don't expect to see it come back to 2%. It's probably going to hold between 5 and 6%. And the Fed may not tame inflation in this cycle. As we said in the last cycle, if it doesn't, it could be create bigger problems like these 3 waves we had in the 70s. I recommended Lynn Alden in our last video in her newsletter, and that's what she said she thought could happen for the rest of this decade. We could be in a wavy inflationary period that is prolonged because we don't tame it in the beginning. So that's my part 2. If you'd like to reach us, this is how you do so. We'd love to have your opportunity to help you in the physical precious metals sector. So thank you for your time. And again, I would watch the oil price on a regular basis to see where the price of oil is relative to where it's been. Right now, we're in between a 95 and a 125 price point. Below 95 means the pressure is easing. Between 95 and 125 means it's holding. Above 125 means we're in for more pain. So thank you for your time. If we can help you, we'd love to have that opportunity. If you'd like, please subscribe to our YouTube channel and like our video. So thank you very much. Good luck.